Hello. So this is Amicus Commercial Mortgages, and you can see there's a picture of us there. We're a very small team. We've only got 24 staff in total, but as far as the sales side is concerned, we've only got two. So it's a very small team. You can see there's a picture of us all there. Yes, there is only 20 people there, not 24. Not everybody was in that day. But this is a picture of us as we launched. We took the decision when we launched to be an intermediary-only lender. It was a decision taken purely because we need to keep ourselves as efficient as possible by working with intermediaries that know us and understand us and have a good knowledge of how to put a deal together and put it to us, means that we can stay efficient and quick. And that's really one of the core tenets of what Amicus Commercial Mortgages is all about. It's being able to offer a very quick and efficient service.
Okay, so Andy again, how to access Amicus Commercial Mortgages. You can call through to Mortgages for Business direct line on 0345 345 6788, or please email inquiry@mortgagesforbusiness.co.uk. We have 5 commercial consultants that work at Mortgages for Business. Your main contact points for Amicus Commercial will be Gareth Richards. Gareth is very specialist on the buy-to-let side of dealings. Gareth is on 01732 471 627. Myself, Andy, on 01732 471 644. And we have Mr. Keddy, Paul Keddy, on 01732 471 655. I'm told between the team of 5 of us, we have over 100 years of experience at writing commercial mortgages. I think Paul has probably about 50 years of writing mortgages to himself.
Right. So product USP. So this is the sort of thing that Amicus Commercial Mortgages are able to offer. So you'll see on the screen up there a few things that we're able to do. So the first one, and what does give us quite a bit of business, is the ability to offer interest only. Now that's quite normal when you're dealing with residential property. What makes us different is we're able to offer up to 75% interest only on commercial property as well. And we can do that in theory up to a term of 20 years. I would say that if we're looking at a larger transaction, so something over £1 million, chances are we wouldn't be comfortable with doing 20 years interest only. We'd probably look to restrict it to more like 10 years or something like that. But it is still something that's quite unique within the market. Another thing that makes us a little bit different is loan to value. So again, on residential security, it's quite often you'll find a lender able to offer 80% loan to value. What makes us different is that we're able to offer 80% loan to value on commercial security. So again, we're talking about shops and flats and industrial units and that sort of thing. What I would say about lending at that sort of loan to value is if we are going to be lending at 80%, we are going to want to be looking at a property that's either more modern in construction or has been recently refurbished and is nicely presented. If it's a little bit tired, it's been a bit knocked about, something like that, chances are we're going to be more comfortable at 70 or 75% rather than going to the full 80%. Another thing that makes us a bit different is where we're refinancing bridging facilities. So what we will do is when we're looking at refinancing an applicant's bridging facility, we won't just restrict what we'll lend to how much they've spent on it. So if somebody has bought something, done some work, got a new tenant in place, really added some value to that property, then we will look at the market value of that property once they've completed all that, not just the aggregate of what they've spent on it in order to get it to that place. Now, having said that, if I get an application that just says, "Oh, actually, last week somebody bought really well at auction, and now it's worth twice what they paid for it," I'm probably going to view that with a little bit of skepticism until such time as it's been proven that they have actually done something to it. Also, on where we're refinancing bridging facilities, we will refinance where an applicant has held the property for less than 6 months. Some lenders will only refinance an applicant once they've held a property for more than 6 months. We will look at it where it's less than 6 months. However, in those circumstances, we do ask for details of the original purchase. And by details, what we mean is, what was the purchase price, where did the deposit come from, that sort of thing. Moving on to first-time landlords, we can lend to first-time landlords, and that is on commercial security as well as residential security again. With residential security, we do have some additional criteria points. So we would need the applicant to be at least 25 years old. We want them to be a homeowner. We'd want the maximum loan to be no more than £500,000, and we wouldn't want to exceed 75% loan to value. On transactions such as that, we'd also want to avoid somebody going into HMOs or multi-lets as their first investment property. We'd prefer for them to keep it simple. If it's a commercial security, so a shop and a flat or something along those sorts of lines, all we're really going to be doing is looking at the applicant's knowledge and experience and ability to manage that property effectively, and in particular, if it's vacant at day one or if there's a likelihood of voids, what are their plans around being able to re-let that property within a reasonable time frame. Another thing that makes us a bit different, no maximum age. We do have a minimum age, which is 21, but no maximum. What I would say on that is, if we are going into retirement age, or if we've got somebody that is quite old, we will need to understand what succession planning, IHT planning is in place, understand what might happen in the event of their demise, so that we understand exactly what sort of transaction we're getting into and what the exit could potentially be. Where we're looking at letting, we've got no minimum lease term, so that's particularly interesting if you're looking at a commercial let property. So if you've got something whereby you've just got short-term licenses or serviced offices or something like that, that's something that we're able to lend against. We don't just insist on 5-10-year leases or something like that, as you might find with some lenders. And we can also consider corporate lets on residential property. So if you're letting to a company or to a local authority or something like that, that's something that we're happy to take a look at and lend against. And last on that USP is flats over businesses. So some lenders have issues with lending on a flat whereby it's over a takeaway or something along those sorts of lines. That's something that we are absolutely able to lend against. And on the buy-to-let slide, I'll talk a little bit more about what sort of loan to values we're able to do on that. But if we move on to the next slide, which is our commercial investment, commercial owner-occupier, this is, as you can see, a very detailed slide. I'm not going to read it out. You can read for yourself. But I just wanted to make a few points clear from this. So where we're looking at sectors, I've listed there what we can lend on. I would just touch on what we can't lend on, which is any form of specialist security. And by specialist, what we generally refer to as that is anything that can't be used for a different purpose. So if you've got something that's very bespoke to whatever it's being used for, chances are it's not going to be a security that we can take, or if it's something within the leisure sector. So if it's something along the lines of a public house or a hotel or something like that, those are the things that at the minute we're not able to lend against. Our pricing, depending on what sort of transaction we're looking for, we lend from LIBOR plus 4.6 for an owner-occupied transaction, and from LIBOR plus 4.7 for a commercial investment transaction. Now, we price off a menu, and we provide that menu to our brokers at Mortgages for Business, and I think they're quite happy to share that. So if you want absolute detail on what sort of interest rate it will work off that sort of menu pricing. Looking at serviceability, you can see the ratio covers there. We do base our serviceability calculation on the pay rate. So that interest rate that you're paying, that's what we're looking to cover, either 130% if we're talking about a capital and interest cover, or 1.5 times if we're talking about interest-only cover. On valuations, as it says there, usually vacant possession. If there is a blue chip tenant in place, then we might look at the investment value, but for sake of prudence, I would say that mostly it's vacant possession that we would lend against. On applicant types, really, rather than pension schemes, we can lend to pretty much any applicant type available. So the full list is there in front of you. We are looking at increasing our range to cover pension schemes at some point in the future, but for the time being, we're not able to do so. And then on credit profile, again, I've put a lot of detail on the slide there that you'll be provided with, so you can take that away. We try to take as lenient a view as possible on credit profile, so we try to be flexible, understand why there might be some blips on a client's credit profile, and try and work with the broker and the client to understand that and really reach a conclusion that says that we're able to lend. So moving on to complex buy-to-let, and this is where I've listed sort of the sectors that we're able to lend to on the complex buy-to-let. So as I've said before, we can lend up to 80% loan to value. That is capped at a maximum loan size of 750,000. Over that, our maximum loan to value is 75%. We will lend on flats immediately above some businesses. So if you've got takeaway with the flat above, we will lend on the flat above. We will restrict that to 65% loan to value, and we would restrict the maximum loan size on something like that to £1 million. If, however, it's in a bigger building and there's another flat between our flat and the takeaway, then we can lend up to 75% loan to value, as it says on that sector slide there. Again, moving on to public sector property, we've got a maximum 75% there, and where we're looking at multi-lets and HMOs, again, maximum loan to value 75% there. Where we've got a multi-unit freehold with 6 or more, or a larger HMO, or an HMO in an area with Article 4 direction, we do look at 70% loan to value. But if you flick down to the valuation basis and have a look at that, the reason the loan to value looks lower on that is because we will actually lend against the investment value on those rather than the vacant possession value. So generally speaking, though, although it's restricted to 70% loan to value, the loan amounts are actually higher because of the valuation basis on that. Pricing, again, is menu pricing, exactly the same as the commercial pieces, but starting from LIBOR plus 4.35. Serviceability criteria, quite straightforward there. Again, serviceability based on pay rate, but there is a minimum of 5.5% on the serviceability criteria. So if our pay rate is lower than 5.5%, we'll test it at 5.5%. If it's higher than that, we will test it at the pay rate. The applicant types and credit profile are exactly the same as what I've just told you for the commercial side. So what really makes us different? And it's these two key points, really. Speed is the main one, and that is the key reason why we win a lot of our business. So we pride ourselves at the speed at which we work. We tend to turn around all contacts within 48 hours of receipt, and often it's within 24 hours. And speed is at the heart of everything we do, and that's one of the reasons, as I mentioned before, why we restrict the routes into Amicus commercial mortgages, is to really maintain that speed and make sure that we are as efficient as we possibly can be on everything we do. Our quickest turnaround time was within something like about 2 weeks. Yes, admittedly, we had the case presented already with the valuation report at that, but we are able to move very, very quickly if the client needs us to do so, and so that is really what we're aiming to do. And then pragmatism. So we're always looking for ways to do the deal, and if that means that we're going to go outside of our stated credit policy, then we're quite happy to do that. So we've had a couple of deals that we've done so far, whereby we've stepped, sometimes quite a long way outside of our credit policy in order to do a deal that we felt passionately was a deal that needed to be done. So in one instance, it was actually an applicant that did have a conviction for a money laundering related offence. It was very historic. There were many mitigating circumstances around how that came about, and it was and in the interim, the client had run a incredibly successful business and was making a good amount of money, and we're happy with everything subsequently. But the simple fact of the matter is, he had been convicted for money laundering, and yet we were still able to get ourselves comfortable with it and do the deal. Another one that we did, where we had a director who was a UK national, but was a resident of Andorra and had been for many years. But the case was mitigated by the applicant's very strong net worth, a very low loan to value, and it was a property let to Sainsbury's. So, in those circumstances, as you might expect, we looked at it, we considered it. Yes, it was a long way outside of our stated credit policy, but we still did it anyway. And it's those sorts of decisions that we're taking day in, day out to try and make sure that we give the best possible service that we can to our brokers and thereon to our customers.
I'd like to say thank you very much to David Stiff, Director of Partner Relationships for Amicus Commercial Mortgages. I would like to add, we've dealt with them on a number of cases here at Mortgages for Business, and apart from their speed and pragmatism, the service levels have been absolutely fantastic. So please do give us a try for either a commercial mortgage, commercial investment mortgage, complex buy-to-let. We can get these deals written for you. And again, just to reiterate, the team members, Gareth Richards, Andy Ellie, Paul Keddy, and our contact numbers 0345 345 6788. Thank you to everyone that's joined the webinar this morning, and we will no doubt have contact with some of you in due course. Thank you very much.
Okay, if anyone has any questions, please do type them in and we'll do our best to answer them. Hi, so we've got a question from Tony. What's the point of the vacant possession value in commercial property, as investors can't be sure until valuation? Which is very true. The investors, as well as the lenders, do rely on our professional valuation partners to give us that figure as and when we get to valuation. What I would say on that is, generally speaking, from a lender's perspective, it's the fallback position that we're looking at when we're lending against these properties. And usually, if a case goes into arrears, it's because the tenant, for whatever reason, isn't paying their landlord. And so chances are what we're going to actually be getting in those circumstances is vacant possession of that property, hence generally lending against the vacant possession valuation. If we, as I said before, if we have a blue chip tenant in place for 15 years, then yes, by all means, we will look at the market value of that property. But generally speaking, because we're obviously looking at it from a security perspective, it's the vacant possession value that we would need to peg our lending against. Okay. Tony's asked us again. So if we repossess, we can reset like you resell a house. Whilst that's true, we don't have any line of sight as to what that tenant quality might be at that point. And obviously the tenant quality is a key driver to what that investment valuation might be. So if we had a really good tenant in there and we lent against the investment valuation, which was driven by the tenant quality, but then got a lesser tenant in, we're going to have a lesser value, and therefore we're not going to have the same value when we try and realise that security. So that's the logic as to why we'd still stick with the vacant possession value.